cost of capitals. Now, what all are the cost of capitals that we have to be worried about? First of all, we have equity. Then we have equity. Maybe we have two types: normal equity and no preference equity. I'll tell you what all methods will be used. Then we have debt, and then we have bank loan. These are the three specific majorly. Within equity, we get two things: normal and preference. Debt may we get three: redeemable, irredeemable, and convertible. And then we have bank. So these are the different types of equities or the capitals that we should be worried about, everyone. Okay, these are the important cost of capitals which needs to be understood and which needs to be gone through once. All the formulas that we'll be talking about, you guys would have already gone through them. I don't think there would be anything which is very new for anyone over here. Be it irredeemable, be it redeemable, or anything over here, more or less would already been covered. Okay. So for the today's agenda, we'll talk about only one topic, that will be your cost of equity. Okay. I give them the shortcuts as well. Normal equity को I'll write down as cost of equity. Preference को I'll write down cost of preference. Debt का I'll directly put down cost of debt. Bank loan को I put down cost of bank loan, KB. These are the short names that I have given myself for the ease. Now, everyone, the very first question comes in, sir, why are we discussing this cost of capital? Again, if you go back to the FM part, whenever you raise finance, you have to give certain returns to the provider. Simplest concept. Whenever you raise finance, you have to give certain returns to the provider, everyone. Now, this returns could be more, less, or whatever. The highest risk will give you the highest return if you are an investor. So that is why the cost of equity, for us, the cost of equity will always be highest. Then comes cost of preference shares, then comes cost of debt, and then comes our cost of bank loan. These are the different types of cost that I as a company has to bear. Always remember, if you are an investor, if you are taking high risk, you will be getting high return. If you are taking low risk, you will be getting low returns. That is the most important concept. Now, when I move forward, okay, and I discuss about very first agenda, which is equity. Over here, we'll be discussing on cost of equity, everyone. There are different methods through which I can find out what is the cost of equity. And the very first method would be the dividend-based manner. The very first method would be dividend-based manner. Okay. Over here, I'll talk about dividend-based. Now, dividend, maybe we have two types: with growth, without growth, with growth. Now, how are we finding out the formula for cost of equity using dividend? Always remember one formula, everyone. The value of any asset, the whole cost of capital is based on this agenda only. The value of any security is equal to the present value of all future cash flows. Remember this line. The value of any security is based on present value of all future cash flows. So I'll just note it down. This will be used somewhere in the future reference. I'm completely sure. Let me write it down in a different color. The value of A security is equal to present value of future cash flows. This line is very important. So all the future dividends that I'm going to get, I just need those dividends to be converted into the present value. That's it. So how can I do that? If you remember perpetuity ka concept, perpetuity says multiplied by 1 by RE. Yeah, 1 by interest. Correct? That is the formula. So when it comes to our dividend, let me take the yellow color for all the formulas. Without growth will be equal to cost of equity dividend upon share price. I hope that is visible to all of you. K equal to D upon P0. But it looks damn too light, right? Let's pick up blue, everyone, because it is looking very light. Without growth, what is the formula? Mm, Cost of equity equal to dividend upon P0. That is without growth. If there is no growth in the dividend, then we simply have to use this formula and we don't have to worry about anything else. Simple as that, right? Now, what will happen if my dividends are going to increase on a normal rate, right? What will happen if my dividend are going to increase? Then how I'm supposed to solve? Then we are going to use another formula for here, which will be equal to cost of equity D0. It is D0 matlab dividend right now. D0 1 plus G upon share price minus growth. How did I got this? Plus growth. Yani dividend after 1 year divided by share price plus growth. I hope all of you know what is D0, G and all these things. Still, I'll write it down for your reference. D0 equal to most recent dividend. P0 will be equal to after dividend share price. Share price G equal to growth. Always remember there is a concept of, let me write it down as well. There is a concept of, I'll note it down somewhere over here. X dividend. Okay. So you are always supposed to consider the share price X dividend. So let's say share price is equal to 10. Dividend announced is 1 rupees. So you will consider the share price as 9 rupees. So remember this thing, everyone. Every time you are solving a question, you have to consider the X dividend share price. Value of share price after deducting dividend. How will you get this question? Let's say they will give you a question which says like the share price is 10 rupees and the company has recently announced a dividend of 2 rupees. Now you might start solving the question using the share price as 10 and that question will be wrong. You have to solve the question using the share price as 8 rupees. Always remember this thing. Okay. Now, within this with growth concept, okay, within this with growth, there are two more models. Okay. First is extrapolation of past dividends. First model, past dividends. And second model is Gordon's growth. There are two models. Okay. So when I talk about first model, past dividends, Abhi, beta, what we are doing, we are finding out this value of G. We are finding out the value of G. Okay, we might have to calculate this value of G. How can I do that? How can we find out the value of G? That is again a question. So this is something that we have already studied in the FM paper as well, right? Gordon's growth model and past dividend model. Abhi, again, if I have to draw a cycle, we talked about cost of equity. Cost of equity, we talked about dividends. We talked about dividend in without growth, with growth, correct? How to use that thing is one part. Now, without growth, the formula was very simple. Dividend right now divided by share price. Nothing else needs to be done. But when it comes to your with growth, we have two models, past dividend and Gordon's growth. How are we going to use both of them? Again, it's a question. So past dividend ka beta, we have a very simple formula which goes like G yani growth, which is equal to under root the value n D0 upon dividend n years ago. Simple. अब इस अंडर रूट को बेटा we can also write it down as, if I remove this under root, I can also write it down for the ease of calculation in Excel, raised to the power 1 by n minus 1. Simple. Right? Now over here, D0 means dividend right now. Dividend n years ago means over here, n stand for number of years. So let's say we have dividends given for today and 5 years back. You will always take the dividend of the last year that is available to you. Always take the dividend of the last year which is available to you. Okay. Then we have Gordon's growth formula, which is again very simple. Over here, what we have to take, G is equal to B into RE. That's it. Where B and RE stands for, B means earnings retention rate. Earnings retention rate, and RE stands for rate of return on equity. RE stands for return on equity percent. Now, both of these will be in percent only. Earnings retention rate will be percent, returns on equity will be percent. So this is one thing that we have to remember, everyone. Again, remember all of these needs to be considered post dividend if the question says so. Okay. So if I solve one question based on the annual growth rate. So we have this question. And then I have one more question for the mm, earnings retention. Just a second, everyone. Let me find question for the earnings retention rate. Okay, great. So these are the two questions that we have, everyone. The very first question talks about, but they will never ask you directly in the question whether you are supposed to use the Gordon's growth or the past dividends model. They will never directly ask you that question. It is up to you. You have to decide whether you are supposed to use dividends or whether you are supposed to use Gordon's or whatever suits best. That is what you have to find out and you have to solve for that. Now, in this question, if you look carefully, only the past dividends are given, right? So how can I go and solve this question? I have the past dividends. So what is the dividend right now? Beta 14.5. What is my dividend right now? I'll go and solve this question using the green pen. Let's take it red only. 14.5. G is equal to average growth they want. 14.5. Now, what is the last dividend that I have received? Sir, 10 over here. Now, what is the different? You might say, sir, last 5, so 1 by n should be equal to 1 by 5. Calculate again. 1 year, 2 year, 3 year, 4 year. So beta it is equal to 4-year gap. Even if you see here 20 to 254, it is only 4 years. If you calculate it individually, then you might say 5 years gap. But if you notice, it is only 1 year, 2 year, 3 year, and 4 year. So there's a gap of 4 years. Minus 1. Look at the formula. D0, dividend right now. Dividend n years ago, the last dividend that was paid by the company. Dividend n years ago. That write down. Minus 1. Now what is the answer that we are getting? We can use the Excel or the calculator as well to put down the power 1 by 4, everyone. Just give me a second. And then subtract it by minus 1. 1.45. One 5 raised to the power if minus 1. The answer is coming out to be 0.097. 0.097 is equal to how much? 9.7%. Okay, everyone. Any doubts in this part, guys? Can we move forward now? Okay. So next question that we have, a company has 300 equity shares in issue with an X dividend. Great point. Market value of 2.70 per share. A dividend of 40,000 has just been paid out of tax profits. Net assets were given. Question is asking cost of equity. Okay. So I'll write it down. Calculate cost of equity. This is the question. Okay. Now, if we start solving this question, just by looking at this question, you can say, can you use, what do you want? You want to calculate the cost of equity. You want dividend upon dividend upon share price. You can can you directly take the share price? Can you directly take the dividend? You might say, "Ki, sir, I can directly take the share price that is given to me." But whenever you think of using dividend, look at whether can you go and calculate the growth. Then you might say, "Sir, I might be able to calculate growth." Which formula can you use? Can you use the past dividend? No, sir. Why? Because only 1 year of dividend is given. That is fine. If the question is giving you total asset value, total amount of profit, then you might be able to calculate B into RE. So now, first of all, I'll go and calculate growth. Growth is equal to B into RE. But the formulas are not necessary in the exam. Don't worry about that part. Now, return on equity and profit retained. So beta, I made a profit of 100,000, and out of that 100,000, I gave 40,000 as profit. So how much am I keeping with myself? 60,000. So 100,000 ka 60,000 is how much? 60%. Correct. How can I do that? 60,000 divided by 100,000. 60%. First point. Then when it comes to return on equity, what is the net assets that I have? You will say, sir, I will have a net asset of 1.06. That is the net assets. Correct. Now, net asset at the end of year was 1.06. What is the total profit this year? How can you calculate return on equity? Return on equity is equal to how much? Profit upon opening net assets. Simple. Profit is given as 100,000. Opening net assets. So opening पे we have 1.06 minus, beta, this includes the 60,000, the retained earning, minus 60,000. How much is the amount?
I think there should be another zero in the
Sorry,
1.6 million. The 1.6 million, right?
1.6.
So,
The return on equity will be 1.6, or the growth rate. Growth rate won't be 1.6. It will be either you
no,
might
no,
say
no.
6 or 16.
I mean the net asset is 1.6 million, right? 1.06 million, sorry. So I think there should be another zero
One zero.
in your calculation.
Oh, yep. Sorry. You're right. 1.06 million to 106,000. That would be the amount. So we'll get how much? Almost it is close to 10%. It is approximately 10. Not accurate, but I'm taking an approximate. It is almost 10. So 60% multiplied by 10% will give you 6% of growth. Okay. Now we have 6% over here in the growth. Then again, we'll go back to my cost of equity formula, which was what? Dividend after 1 year. What is dividend right now? The question comes, what is the dividend right now? 40,000. Total dividend. Let's take up total. 40,000 multiplied by, after 1 year will be how much? 1.06 divided by share price, which is how much? 2.7. But now we have to take total share price, which will be how much? Is it given? 300 into 2.307 plus growth rate 0.06. Let's go and solve this part. Equal to 42,400 divided by 7. 7.2. So that will be your final answer, 11.2%. You can go and solve it on your own once, everyone.